The stock market is hitting all-time highs. The pundits on CNBC are smiling. They're telling you that the economy is resilient, that the tech sector is unstoppable, and that inflation is under control. They point to the S&P 500 and say, look at the chart, everything is fine. But they are looking at the surface of the ocean. They are not looking at the tectonic plates shifting beneath the waves. We are here to tell you that the calmness you see in the stock market is a lie. It is a mirage created by leverage, algorithms, and a financial structure that is rotting from the inside out. We are staring down the barrel of an invisible crash. A crash that will not start on Wall Street, but in the futures pits of the commodities market. A crash that will not be triggered by bad earnings or a recession, but by a forced liquidation event that nobody is talking about. To understand this, you have to stop looking at the banks you know. Forget JP Morgan. Forget Bank of America. They are regulated. They have capital requirements. They are the visible banking system. We need to talk about the shadow banking system. Shadow banks are non-bank financial intermediaries. They are hedge funds. They are private equity firms. They are massive commodity trading advisors, CTAs. These entities manage trillions of dollars, but they operate in the dark. They do not have access to the Federal Reserve's discount window. They do not have FDIC insurance. And most importantly, they do not have the same limits on leverage. While a commercial bank might be leveraged 10 to 1, a shadow bank using derivatives can be leveraged 50 to 1 or even 100 to 1. They are giant, towering structures of debt built on a foundation of sand. And right now, the foundation is shifting because of one specific asset, silver. You might ask, how can a spike in silver crash the stock market? Silver is a tiny market. That is true. The physical silver market is tiny. But the paper silver market is a cornerstone of the hedging strategies used by these massive funds. This brings us to the concept of risk parity. Risk parity is the most popular investment strategy of the last decade. It was popularized by heavyweights like Ray Dalio at Bridgewater, but now it is used by almost every major algorithmic fund in the world. The strategy is simple. You buy stocks to capture growth, and you buy bonds to hedge against a crash. The theory is that when stocks go down, bonds go up. They balance each other out. It is the all-weather portfolio. But to make this strategy generate high returns, these funds use massive leverage. They borrow money to buy more bonds and more stocks. And to hedge against inflation, the one thing that kills both stocks and bonds, they take short positions in commodities or use complex derivatives to manage volatility. They are short volatility. They are betting that the market will remain stable. Here's the nightmare scenario that is unfolding right now. We are entering a period where stocks and bonds are falling together. This is the correlation breakdown. Inflation is killing the bond market. Yields are rising. At the same time, the slowing economy is hurting the stock market. The risk parity funds are losing money on both sides of the trade. Their hedges are failing. And then you have silver. Silver is the wild card. Many of these funds use silver and gold futures as part of their carry trade, or as a hedge against the dollar, or they are simply short commodities because they are betting on a recession. When silver spikes 10% in a day, as we discussed in our previous dossier, it sends a shockwave through the risk models of these shadow banks. The computer algorithms that run these funds calculate something called value at risk, or VAR. When volatility spikes in a core asset like silver, the VAR alarm goes off. The algorithm says, risk is too high. You must deleverage immediately. Deleveraging is a polite word for forced selling, but the fund doesn't have a choice. It isn't a human trader making a decision. It is a line of code executing a command. The command is, sell assets to raise cash to cover the margin call. Now think about this. If you are a massive hedge fund and you are bleeding billions of dollars because your silver short is blowing up and your bond portfolio is crashing, where do you get the cash? Do you sell your silver position? You can't. The market is limit up. There's no liquidity. Do you sell your corporate bonds? You can't. The bond market is illiquid and crashing. You sell what you can, not what you want. What is the most liquid asset in the world? What can you sell billions of dollars of in a split second without crashing the price immediately? The S&P 500, Apple, Microsoft, Nvidia, the Magnificent Seven tech stocks. These stocks are the piggy bank for the shadow banking system. They hold them not just because they like the companies, but because they are cash equivalents. They are the ATM. When the silver margin call hits, they go to the ATM and they withdraw cash. This means they dump massive blocks of tech stocks onto the market. This is why you often see gold and silver spike and the stock market crash at the exact same moment. It isn't because the stock investors are analyzing the metal market. It is because the same funds own both. They are being forced to liquidate their winners to pay for their losers. This creates a feedback loop. As they sell stocks, the stock market drops. This triggers volatility in the equity markets. Higher volatility triggers more VAR alarms in other funds. Now, funds that aren't even involved in silver start selling because their risk models are flashing red. It spreads like a virus. We saw a preview of this in March 2220. We saw it in 2008. But this time, the leverage is higher and the trigger, a commodity squeeze, is more violent. The shadow banks are currently sitting on the largest short position in bonds in history, and they are massively long tech stocks. They are perfectly positioned for a liquidity event. The regulators know this. The Federal Reserve knows this. That is why they are holding secret meetings. They are not worried about the price of silver being $80 for the sake of silver. They are worried that an $80 silver price triggers a $1 trillion margin call that forces the liquidation of the U.S. stock market. They are terrified of the cross-asset contagion. They know that the markets are all tied together by a web of debt. You pull on the silver thread, and the entire tapestry unravels. The average investor looks at their 401k and sees Apple stock. They feel safe. They do not realize that their Apple stock is being used as collateral by a hedge fund in the Cayman Islands to leverage a bet against silver. They do not realize that their retirement security is inextricably linked to the frantic maneuvers of a desperate trader trying to cover a short position in a metal they don't even understand. This is the invisible crash. It is invisible because the mechanism is hidden in the plumbing of the repo market and the derivatives market. But the effects will be very visible. You will see the Dow Jones drop 1,000 points in an hour. You will see trading halts. You will see panic. And you will wonder, why is this happening? The earnings were good. It is happening because the shadow banks are blowing up. They are being carried out on stretchers. And in their death throes, they are taking the rest of the market down with them. In the next section, we are going to walk you through the specific mechanics of the margin call from hell. We will explain the role of the prime broker, the timeline of the liquidation, and why the algorithms will turn a correction into a catastrophe. We will explain why, in a liquidity crisis, correlations go to 1. Everything falls together, except the one thing they need to buy, except silver. Stay tuned. We are going to expose the plumbing of the disaster. To understand the violence of the coming crash, you have to understand the relationship between the hedge fund and the prime broker. The prime broker is usually a major investment bank like Goldman Sachs or Morgan Stanley. They are the ones who lend the shadow banks the money to trade. They are the ones who hold the collateral. They are the gatekeepers. When a hedge fund puts on a risk parity trade, leveraging up bonds and stocks while shorting commodities, they are doing it with the prime broker's money. The prime broker sets the terms. They set the margin requirements. And crucially, they have the power to change those requirements overnight. Imagine it is Monday morning. Silver is opened at $85, gaping up violently. The hedge fund manager, let's call him Fund X, wakes up to a red screen. His short position in silver has just lost 20% of its notional value. But because he is leveraged, his actual equity loss is massive. At 8:30 a.m., the phone rings. It is the risk department of the prime broker. The conversation is short and brutal. Your collateral value has dropped below the threshold. We are raising margin requirements on all commodity positions to 100% due to volatility. You have a $5 billion margin call. You have 1 hour to wire the funds. 1 hour. Fund X doesn't have $5 billion in cash sitting in a checking account. Hedge funds stay fully invested to maximize returns. Their cash is tied up in assets. Now the manager is in the kill zone. He has to raise $5 billion in 60 minutes, or the prime broker will take over his portfolio and liquidate it for him. And trust me, you do not want the prime broker liquidating your portfolio. They don't care about the price. They just hit, market sell. So the manager looks at his screen. He needs to find $5 billion. He looks at his bond portfolio. The bond market is frozen. Treasury yields are spiking. If he tries to sell $5 billion of 30-year treasuries right now, he will crash the bond market and get a terrible price. Plus, he is losing money on bonds too. He can't sell the loser to pay for the loser. He looks at his emerging market stocks, too illiquid. He looks at his private equity holdings. You can't sell those in an hour. It takes months. His eyes land on the only green line on his screen, the S&P 500 futures, the NASDAQ 100, his massive position in quality tech. This is the unencumbered collateral. It is the only thing that has a deep enough bid to absorb $1 billion sell order. He gives the order, sell the spiders, SPY. Sell the Qs, QQQ, sell Apple, sell Amazon, get me the cash. This is forced selling. It has nothing to do with the fundamental value of Apple. Apple could have just cured cancer and Fund X would still sell it. This is mechanical selling. It is a liquidity transfer. As Fund X starts dumping billions of dollars of tech stocks, the price begins to tick down. This is where the second layer of the nightmare kicks in. The high-frequency trading algorithms, HFTs. The markets today are not run by humans. They are run by bots. These bots are predators. They sniff order flow. They can see when a large entity is forced to sell. When the HFTs see a massive sell order hitting the bid for Apple, they do not step in to buy. They pull their bids. They disappear. This is called a liquidity vacuum. The HFTs realize there is a distressed seller. They cancel their buy orders and step lower. They want to buy, but they want to buy at a 10% discount, not a 1% discount. They front-run the sell order, shorting the stock ahead of the whale, driving the price down even faster so they can cover lower. So Fund X is trying to sell, but there are no buyers. The price enters free fall. Apple drops 3% in 5 minutes. The S&P 500 futures hit a limit down halt. Trading pauses for 15 minutes. During this pause, panic spreads. Other hedge funds, let's call them Fund Y and Fund Z, see the market crashing. They don't know why it's crashing. They don't know about Fund X's silver problem. All they see is that their own portfolios are dropping. Their VOR models start screaming, volatility is rising. Correlations are going to 1. Sell, sell, sell. Now, Fund Y and Fund Z are selling their stocks too. They are selling to protect themselves. This is the feedback loop. The selling causes volatility, which causes more selling. It is a self-fulfilling prophecy of destruction. And remember the prime broker? They are watching this too. They see the value of the collateral, the tech stocks, dropping. They call up Fund X again. Hey, remember that $5 billion margin call? Well, since you started selling, the value of your remaining stocks has dropped. Now you owe us $7 billion. It is a death spiral. The more they sell, the more the market drops, and the more they have to sell. Meanwhile, in the silver market, the price is ripping higher. Why? Because some funds are trying to buy back their shorts to close the position. This puts upward pressure on silver at the exact same moment there is downward pressure on stocks. This creates a massive divergence. Historically, silver and stocks often move together. They are both risk assets. But in a liquidation crisis, they decouple. Silver becomes the anti-asset. It is the thing causing the pain. Stocks become the victim asset. They are the thing being sacrificed. We also have to talk about the CTA funds, commodity trading advisors. These are trend-following algos. They control hundreds of billions of dollars. If silver breaks a key technical level like $80 or $100, the CTA models flip from short to long. This is the equivalent of pouring gasoline on a forest fire. If the CTAs flip long, they will automatically buy billions of dollars of silver futures. This drives the price of silver even higher, which inflicts even more pain on the risk parity funds, which forces them to sell even more stocks. It is a perfect machine of destruction. The gears are interlocking. You cannot stop one gear without breaking the whole machine. The invisible crash is invisible because the average person thinks the stock market reflects the economy. They think unemployment is low, people are buying iPhones, so stocks should go up. They do not understand that the stock market is actually a derivative of global liquidity conditions. It is a reflection of how much leverage is in the system. When leverage is added, stocks go up. When leverage is removed, forced liquidation, stocks go down. It is that simple. And right now, we are seeing the most violent removal of leverage in history. The scary part is the speed. In 1987, the market crashed 22% in one day. In 2025, with the speed of modern computers, it could happen in an hour. The flash crash of 2010 lasted 36 minutes. The coming crash could wipe out trillions of dollars of wealth before you even finish your morning coffee. This is the mechanics of the margin call. It is cold, it is mathematical, and it is unstoppable. Once the domino falls, gravity takes over, Fund X fails, then Fund Y fails, then the prime broker gets into trouble, then the system freezes. In the next section, we are going to bring this down to Main Street. We are going to talk about what this means for you, your 401k, your pension, your passive index funds. We will explain why the passive investing revolution has actually made the market more dangerous, and why the exit door is too small for everyone to get out. You're about to find out that you're the bag holder for the shadow banks. Now we leave the glass towers of Manhattan and come to your kitchen table. You're checking your phone. You see the alert. Dow Jones down 2,000 points. You feel that pit in your stomach. You log into your 401k account. The website is slow. It's struggling to load. When it finally opens, you see the damage. You are down 15% in a single day. You ask yourself, why? I did everything right. I bought the index funds. I diversified. I hold the target date 2035 fund. I'm a long-term investor. This is the tragedy of the modern financial system. You have been sold a lie called passive investing. You were told that if you just buy a basket of stocks and hold them, you will be fine. You were told that time in the market beats timing the market. But here's what they didn't tell you. Passive investing only works when there is liquidity. Passive investing relies on the assumption that there will always be a buyer when you want to sell. But as we established in the previous section, the shadow banks are dumping massive amounts of stock, and the high-frequency traders have pulled their bids. So who is the buyer? You are. Or rather, your pension fund is. Your index fund is. When you buy an ETF like SPY or VOO, you are mindlessly buying whatever is in the index. You are price insensitive. This blindly flows money into the largest companies. But when the crash starts, the flows reverse. Here is the problem with your 401k structure. It is likely a 60-40 portfolio. 60% stocks, 40% bonds. This portfolio construction is designed to protect you. But in the scenario we are describing, the silver-triggered liquidity crisis, both stocks and bonds are falling. Your 401k is not hedged. It is exposed to the exact same risks as the hedge funds, but with zero agility. You cannot short. You cannot go to cash instantly. You are a sitting duck. Let's talk about the pension funds. These are the giants, CalPERS, the teachers' unions, the police pensions. They manage trillions. They are also heavily invested in the risk parity strategies we discussed in part 1. They use leverage to try and meet their 7% annual return targets because bonds yield too little. When the hedge funds start liquidating, the pension funds get the call next. They are slower. They have boards of directors. They have meetings. By the time they decide to de-risk, the market is already down 20%, so they end up selling at the bottom. This destroys the solvency of the pension system. This crash connects directly to the wealth effect. The Federal Reserve has spent 15 years pumping up the stock market to make people feel rich so they will spend money. It worked, but it works in reverse too. When your 401k drops 30%, you stop spending. You cancel the vacation, you don't buy the new car, you don't renovate the kitchen. This sends the real economy into a tailspin. Corporate earnings collapse. This validates the drop in stock prices, causing them to drop further. It is a recession caused by a financial accident. But the most terrifying part for the retail investor is the concept of the gated fund. You might have money in a real estate investment trust, RIT, or a private credit fund. These became very popular as people searched for yield. When the market crashes, retail investors panic. They hit the redeem button on these funds. They want their cash back. But these funds hold illiquid assets. They can't sell an office building in a day. So what do? They gate the fund. They send you an email. Due to exceptional market conditions, we are suspending redemptions. You cannot get your money out. Imagine the horror. You have $100,000 in a fund. You can see it on the screen, but you cannot touch it. You are locked in a burning building. The managers tell you it's for your own protection. It isn't. It is to protect them. This is already happening. We have seen major REITs limit withdrawals. In a full-blown crash, this will happen across the board. The liquidity vacuum means that on-demand liquidity is a myth. And where does silver fit into your 401k? It doesn't. Most 401k plans do not allow you to buy physical precious metals. They might allow a mining stock ETF if you have a brokerage window, but most people are in generic funds. So, while the silver price is skyrocketing to $100 or $200, acting as the only lifeboat in the storm, your retirement account is forbidden from owning it. You are structurally forced to be short the one asset that is going up. This is not an accident. The system is designed to funnel your capital into the financial assets that benefit the banks, stocks and bonds, and keep you away from the assets that grant you independence, gold and silver. You are the collateral damage in a war between the shadow banks and the physical reality of the market. The shadow banks over-leveraged. They got caught short silver, and now, to save themselves, they are burning down the stock market where your savings live. The invisible crash becomes very visible when you realize you can't retire, when you realize the safe withdrawal rate is now zero, when you realize that the paper wealth you thought you had was just a digital illusion maintained by low volatility. Volatility is truth, and the truth is coming. In the next and final section, we will look at the response. How will the Federal Reserve react when the S&P 500 is down 30% and silver is up 100%? They are trapped in a dilemma with no solution. We will explain yield curve control and why the only way to save the stock market is to sacrifice the dollar. This leads to the crack-up boom, where stocks eventually rise, not because they are valuable, but because the money is worthless. And we will give you the final roadmap on how to position yourself so you are not the victim of the liquidation. We have reached the end game. The shadow banks are liquidating, the stock market is in free fall, the pension funds are insolvent, the average American is watching their 401k vaporize. The streets are filled with panic. The phone rings at the White House. The phone rings at the Federal Reserve. It is the plunge protection team. The Federal Reserve is now facing the ultimate nightmare, a paradox that economic textbooks say shouldn't exist. They are facing a crashing stock market, deflationary signal, and a skyrocketing commodity market, inflationary signal at the same time. Normally, if stocks crash, the Fed cuts interest rates and prints money, QE, to save them. This is the Fed put. It has worked for 40 years. But this time, the trigger for the crash is inflation in the commodity sector. The trigger is silver. If the Fed prints $1 trillion to bail out the hedge funds and save the S&P 500, that new money will flow instantly into the hottest asset on the planet, silver. If they print money, silver doesn't just go to $100. It goes to $200, $300, $500. It goes hyper vertical. This causes the price of everything else, gas, food, electronics, to explode. It triggers hyperinflation. So the Fed has a choice. Option A, Save the stock market and the bond market, but destroy the dollar and cause hyperinflation. Option B, save the dollar and fight inflation, but let the stock market and the banking system collapse completely. History tells us they will choose option A. They always choose to save the system they control. They will sacrifice the currency to save the banks. This leads to the pivot. You will see the Fed chairman walk out to the podium. He will look shaken. He will announce emergency measures to stabilize market function. He will announce that the Fed is opening a liquidity facility to buy corporate bonds and stocks. He will announce yield curve control, the YCC. YCC means the Fed will print infinite money to buy treasury bonds to keep the rates low. They cannot afford for rates to rise, or the government goes bankrupt. The moment this announcement is made, the dynamic changes. The liquidity crash ends, and the crack-up boom begins. The crack-up boom is what happened in Weimar Germany or Zimbabwe. The stock market rises. It might even go to new all-time highs. But it is rising in nominal terms only. The numbers go up, but the value goes down. If the Dow Jones goes to 50,000, but a loaf of bread costs $50, are you richer? No. This is the transition you must prepare for. The invisible crash we described in parts 1 to 3 is a deflationary shock. It is the sound of money being destroyed by margin calls. It might last a week, a month, or 3 months. It is the period where cash is king. But the reaction to that crash, the Fed printing press, triggers the inflationary tsunami. This is the period where cash is trash. Your strategy must be nimble. Phase 1, the liquidity crunch. Right now, immediate future. You want to be out of leveraged tech stocks. You want to be out of corporate bonds. You want to hold cash for the dip and physical gold, dollar, silver, which has no counterparty risk. During the crash, silver might be volatile. It might dip initially as people sell it to raise cash, as we discussed, but it will rebound faster than anything else. Phase 2, the Fed pivot. The moment they announce bailouts. You sell your cash, you buy hard assets with both hands, you buy the miners, you buy energy, you buy the things that survive inflation. Do not be fooled by the nominal recovery of the stock market. When the S&P 500 bounces back, the media will say, the crisis is over. It is a lie. The crisis has just mutated. The stocks are rising because the dollar is dying. This is why the invisible crash is so dangerous. It destroys the middle class in 2 steps. First, it scares them out of their positions at the bottom during the liquidation. They sell their 401k at a 40% loss because they are terrified. Then, when the Fed prints the money, the market rips higher, leaving them behind, holding worthless cash that is being inflated away. They get sold out at the bottom and inflated out at the top. It is total wealth destruction. But for the shadow banks, the ones that survive, they get bailed out. The Fed buys their toxic assets. They get to keep their bonuses. The transfer of wealth goes from the saver to the speculator, unless you own silver. Silver is the one asset that stands outside this corrupt loop. It is the one asset that the Fed cannot print. It is the one asset that benefits from both the fear, crash, and the solution, inflation. When the hedge funds are liquidating, silver is the cause. When the Fed is printing, silver is the beneficiary. It is the sword and the shield. So when you see the headlines screaming market turmoil, hedge fund blow up, emergency Fed meeting, do not panic. Smile. This is the sound of the system resetting. This is the sound of the leverage unwinding. The invisible crash is necessary. It is the forest fire that clears the dead wood. It is painful, yes, but it clears the way for real price discovery. Your 401k might take a hit. Your paper wealth might fluctuate. But if you hold the metal, if you hold the physical reality, you will come out the other side stronger. You are not dependent on the shadow banks. You're not dependent on the algorithm. You are your own central bank. The crash is coming. The liquidation is imminent. The SPY is the target. And silver is the bullet. Prepare accordingly. The show is about to start.